In 2009, after the worst housing crash since the Great Depression, something remarkable happened. For a brief moment, housing in the United States made sense again. The median home price fell to a level that, relative to incomes, felt almost rational. A reset, a clearing of excess, a painful but necessary purge of leverage and illusion. But that moment did not last. What followed was not a recovery in the traditional sense, it was an acceleration. Prices did not simply rebound, they detached. They outran wages, productivity, and reality itself. By 2024, the median home price in the United States crossed $420,000, the highest level ever recorded, while real wages remained effectively flat for the fifth consecutive year, not falling, not rising, just frozen as the ground beneath them disappeared. Today, housing affordability is worse than it was at the peak of the 2006 bubble, worse than 1984, worse than any point in modern American history where reliable data exists. And this time, the damage is not evenly distributed. It is generational. In over 99% of counties across the United States, the average home is now officially classified as unaffordable for the median worker. In 1985, a typical first-time buyer needed about 5 years to save for a 20% down payment. Today, that number is 13 and a half years, the longest timeline ever recorded. Mortgage payments alone have surged more than 113% since 2020, not because homes suddenly became better, but because money became cheaper, then violently more expensive again. This is not a slow erosion. This is the fastest collapse of housing affordability in American history. And yet, prices are not falling. That contradiction is the key to understanding why this crisis is not just worse than 2008, but fundamentally different. The baby boomer generation is now sitting on roughly $12 trillion in home equity. But most of that equity is locked behind sub-3% fixed-rate mortgages that they will never voluntarily give up. Selling would mean trading a once-in-a-lifetime loan for rates that feel punitive by comparison, so they stay, they hold. Inventory freezes. At the same time, institutional investors quietly entered the market with scale, speed, and balance sheets no family could compete with. Firms like BlackRock, Invitation Homes, and their peers have spent over $60 billion acquiring single-family homes, often before they ever hit a public listing. Entire neighborhoods were absorbed not as communities, but as yield-producing assets. For the first time in United States history, the majority of adults under 40 now believe they will never own a home. And here's the part no one wants to say out loud. This is not a collapse of prices. It is a collapse of opportunity. A society where most of the next generation is permanently locked out of ownership is not a stable society. When people own nothing, they do not feel invested in the system that governs them, because they are not. When effort no longer converts into security, when patience no longer leads to progress, people disengage, or they radicalize, or they burn the whole thing down. This is not a bubble you wait to pop so you can buy the dip. This is a financial chokehold, built slowly, then all at once, by money printing, policy failure, demographic timing, and corporate consolidation. And the consequences are already here, just not in the form most people expect. This is worse than 2008, and for those paying attention, there are still ways to survive it, even to benefit from it, but not without understanding what actually happened. Because if you misdiagnose the problem, every solution you chase will fail. So welcome to part 1, what actually happened, and how housing quietly killed the American dream. For most of the 20th century, the path into the middle class was brutally simple. You got an education, you got a job, you bought a home. Over time, you built equity, you passed something forward, wages rose, debt was manageable. The United States benefited from its position as the world's manufacturing engine after World War II. Productivity gains flowed, imperfectly but meaningfully, to workers. That upward trajectory was not accidental. It was embedded in the structure of the economy. But a fuse had been lit much earlier, in 1913, when the United States created a central bank, granting itself the ability to expand the money supply at will. At first, the consequences were subtle, almost invisible. But over decades, the effects compounded. As more money entered the system, assets began to matter more than labor. Owning a home went from being a milestone to being a requirement. For a while, that was fine. A house made sense. You could live in it, raise children in it, protect yourself from inflation without needing a finance degree. But in 1971, the final tether to gold was cut. The dollar became purely fiat. And from that moment on, debt and money creation became the default response to every economic shock. The dot-com crash, the 2008 financial crisis, and then, during the pandemic, money printing reached levels previously unthinkable. When money is printed faster than goods and services are produced, prices rise. That is inflation, and inflation does not hit everyone equally. If your wages rise with inflation, you survive. If they do not, you fall behind. And if you own assets that rise faster than inflation, you pull ahead. For roughly 4 decades now, real wages in the United States have stagnated. Globalization capped labor bargaining power, manufacturing moved overseas, productivity gains flowed upward. That left only one viable defense against inflation: asset ownership. And housing became the default hedge. After 2008, credit collapsed for ordinary buyers, but not for corporations, not for the already wealthy. And as interest rates sat near zero for more than a decade, those who already owned homes refinanced into historically low fixed mortgages, locking themselves in permanently. At the same time, new construction slowed to a crawl. Home building fell nearly 40% compared to the 1970s, even as the population grew by over 130 million people. Zoning laws, density restrictions, lengthy permits, and neighborhood opposition made it nearly impossible to add supply where people actually wanted to live. By the time the pandemic arrived, the system was already fragile. Then came another tsunami of printed money: supply chain disruptions, mass migration into housing markets, and institutional capital flooding into single-family homes. 4 forces converged: wage stagnation, inflation, artificially restricted supply, and competition from entities with effectively unlimited capital. Prices exploded. But this was not strength. This was malfunction. High prices are not always a sign of a healthy market. Sometimes they are evidence of a system working exactly as designed, just not for you. And that is why, today, the United States is experiencing a housing boom that feels like a collapse to everyone locked outside of it. This is only the beginning. In the next part, we are going to talk about who benefits from this system, who shaped it, and whether this outcome was accidental or simply inevitable given the incentives involved. If Part 1 explained how the system broke, Part 2 answers the more uncomfortable question: how bad is it really? And who, exactly, built this outcome? Because housing affordability today is not just slightly worse than before. It is worse than it was at the peak of the 2006 bubble, the moment everyone now agrees was insane. Americans under 40 increasingly believe they are more likely to become millionaires through crypto speculation or outright gambling than through owning a home. That belief did not emerge from delusion. It emerged from data. People over the age of 70 are now more than 70% wealthier than people of the same age just 40 years ago. People under 40, by contrast, are roughly 24% less wealthy than their counterparts from the 1980s. Older Americans now control more than half of all residential real estate wealth in the United States, more than every younger generation combined. Institutional investors have spent over $60 billion buying homes that ordinary buyers will never even see listed. Zoning laws written in the 1970s still block roughly 75% of all potential new housing in major metropolitan areas. And if you trace this back honestly, you do not find a single villain twirling a mustache in a boardroom. What you find instead is something far more dangerous: incentives. A long chain of individually rational decisions that, taken together, created a machine that relentlessly punishes anyone who was not already inside it. Once those incentives hardened, the outcome became inevitable. There are 3 groups worth examining if you want to understand who shaped the housing crisis. Not because they are evil, but because they were powerful. And power, when combined with incentives, shapes reality. The first group is politicians. To understand politicians, you have to accept one immutable truth: their primary objective is not long-term economic health, it is gaining and retaining power. Everything else is secondary. And for decades, politicians at the local, state, and federal level made decisions that directly restricted housing supply. Not because they misunderstood economics, but because that is what voters demanded. Restricting supply raises prices. Rising prices make homeowners feel richer, and homeowners vote at far higher rates than renters. So zoning boards made it nearly impossible to build anything other than single-family homes on large lots. Neighborhood groups fought density, fought multifamily construction, fought height increases, fought anything that might introduce competition into the housing market. None of this was framed as greed. It was framed as protecting neighborhood character, preserving community, maintaining quality of life. But the economic effect was the same: scarcity. Politicians understood this perfectly, and because no one gets reelected by telling voters their biggest asset might stop appreciating, or that budgets must be balanced, or that entitlements need reform, or that banks should be allowed to fail, politicians chose the path of least resistance. They promised free things. And free things require borrowed or printed money. This is where the cycle becomes self-reinforcing. Deficit spending requires money creation. Money creation drives inflation. Inflation pushes people into assets. Housing absorbs that demand. Rising prices create political pressure to protect existing homeowners, and so supply remains restricted. Every empire in history has followed this path: debt, money printing, asset inflation, social fracture, decline. It is not controversial in history, it is only controversial in the present. Politicians did not set out to break the housing market, but by prioritizing short-term stability and re-election over long-term balance, they guaranteed that future generations would pay the price. And now, those costs are coming due. The second group is the baby boomer generation. This is where the conversation often turns emotional, so it is important to be precise. Boomers are not villains because they are immoral. They are simply human. They optimized for their own safety and prosperity, just like every generation before them would have done under the same conditions. They bought homes when prices were low relative to income, when wages were rising, when debt levels were reasonable, when interest rates, while higher, reflected a healthier monetary system. Then, over decades, they voted for policies that protected and amplified the value of their largest asset. That made perfect sense from their perspective. Then came a series of monetary shocks. Interest rates collapsed, money flooded the system, and boomers were able to refinance into ultra-low fixed mortgages that effectively froze their housing costs for life. This was not malicious, it was timing. But timing matters. Because once those mortgages were locked in, there was no incentive to move, no incentive to downsize, no incentive to sell. Inventory became trapped, housing stock stopped circulating, and young buyers were forced to compete for a shrinking pool of homes at a moment when borrowing costs were dramatically higher. Then there is the inheritance cliff. A massive share of United States housing is now held by people over 65. Much of it will transfer to their children, and those children are overwhelmingly already in the upper half of the wealth distribution. That means the next wave of home ownership will concentrate wealth even further. Mobility slows. Meritocracy erodes. The system begins to resemble a caste structure rather than a dynamic economy. This does not mean inheritance is immoral. In fact, the ability to pass wealth forward is one of the few mechanisms that breaks cycles of poverty. But when combined with permanent scarcity and constant bailouts, inheritance stops being a ladder and becomes a wall. When failure is never allowed, success calcifies. Which brings us to the third group, Wall Street and institutional investors. These firms did not enter the housing market by accident. They entered because the math became irresistible. Near zero interest rates meant leverage was cheap. Inflation meant rents and asset prices would rise. Zoning restrictions guaranteed limited supply, and algorithmic buying allowed firms to outbid families instantly. They did not buy homes one at a time. They bought entire neighborhoods. To them, houses were not places to live. They were financial instruments, cash flow machines, inflation hedges. Once single-family homes could be packaged, securitized, and scaled, they became a new institutional asset class. Neighborhoods stopped being communities. They became rental portfolios. And because these firms could pay in cash, absorb losses, and operate at scale, they permanently altered the market. Young families were no longer competing with each other. They were competing with balance sheets measured in trillions. Now, it is tempting to point to any one of these groups and assign blame. Politicians restricted supply and inflated prices. Boomers locked inventory and voted to protect themselves. Corporations devoured what remained. But the truth is simpler and more unsettling. This was not a conspiracy. It was incentives stacking over time. And the unavoidable result is this. If you own assets, the last decade has been extraordinary. If you do not, it has been brutal. The housing crisis is not a market failure. It is a policy success for a very narrow segment of society. The question now is not whether this system is fair. The question is what you do inside of it. In the next part, we are going to talk about how individuals can still navigate this environment, how asset ownership has functioned historically during periods like this, and what paths still exist even when the front door feels permanently closed. Because while you cannot change the system overnight, you can learn how it works, and that knowledge matters more now than ever. By this point, it should be painfully clear that waiting for the system to fix itself is not a strategy. The housing market is not broken in a way that naturally self-corrects. It is functioning exactly as its incentives demand. And that means the burden of adaptation falls, unfairly but unavoidably, on the individual. So the real question becomes this: how do you survive, and possibly even win, inside a system that is structurally hostile to newcomers? To answer that, you have to start by understanding the scale of what already exists. Homeowners in the United States currently hold over $32 trillion in home equity. That is more than the combined gross domestic product of the United States and China. And historically, over nearly every 20-year period across the last century, Homeowners have accumulated between 30 and 40 times more wealth than renters, even accounting for recessions, crashes, and wars. People who managed to buy during the last major affordability crisis did not feel smart at the time. They felt desperate. But over the following decades, many saw their home values rise several 100%. Markets that feel impossible today have often delivered the highest long-term returns precisely because scarcity becomes a tailwind once you are inside. This does not mean prices will go up forever in a straight line. It means that over long periods, land and housing have consistently outpaced inflation and wage growth. That dynamic is not emotional. It is structural. The uncomfortable truth is that the system is designed to reward asset ownership and punish cash. Inflation acts like an invisible tax. No one votes for it, but everyone pays it. At 3% inflation, cash loses roughly half its purchasing power over 24 years. At higher rates, the damage accelerates. This is why thinking in monthly payments alone is dangerous. Most people ask, can I afford this payment? Capital allocators ask a different question. Is my money outrunning inflation, or is it being eaten alive by it? Cash sitting still is not safe. It is a melting ice cube. The right assets move with or ahead of inflation. Housing, stocks, land, gold, Bitcoin, even art. Each carries different risks, but they share one critical trait. They are not standing still while currency is being debased. It is important to say this clearly. You do not need to buy a house to protect yourself from inflation. A diversified basket of uncorrelated assets is often more resilient. Housing is not the only answer, but housing remains unique for one reason. Most people intuitively understand it. You can live in it, build a life in it, raise children in it, improve it. You do not need to stare at a screen or decipher charts, and when structured correctly, a home becomes a forced savings account that historically keeps pace with inflation while renters absorb every price increase with nothing to show for it. That does not make housing risk-free. Mortgage payments are sensitive to interest rates. Buying at high rates can feel suffocating, but if rates fall, you may refinance. If rates rise further, you will be grateful you locked in when you did. And unlike most assets, you can live inside the thing that is protecting your wealth. The first step, then, is not buying your dream home. It is getting into ownership at all. Waiting for perfection is how people watch decades pass from the sidelines. Entry-level ownership matters more than aesthetics. House hacking remains one of the most powerful tools available. Buying a duplex, triplex, or fourplex. Living in one unit and renting the others. Buying a modest home and renting rooms, a basement, or an accessory unit. It is not glamorous, but it radically changes the math. If prices are extreme where you live, doing it alone may not be realistic. Co-ownership with someone you trust can work. A sibling, a friend, a partner, but it must be treated like a business. Terms in writing. Exit plans defined. Clarity prevents resentment. And if even that is out of reach, scale the size of the asset, not the ambition. Fractional ownership. Well-vetted real estate investment trusts. Small positions that provide exposure and learning. You cannot live in them, but they get you into the asset class and help you develop judgment before making larger commitments. For those further along, land deserves mention. Land is essentially a long-dated option on the future. It may not produce income today, but if growth arrives, the upside can be asymmetric. This is speculative and requires discipline, but history shows that land scarcity compounds powerfully over time. Another critical step is positioning yourself for distressed opportunities. Every cycle has moments of panic. Credit tightens, headlines scream, over-leveraged owners are forced to sell. Regions once considered untouchable correct sharply. It has happened repeatedly. It will happen again. You cannot predict the exact moment, but you can prepare. Know what markets you would buy in, what price ranges make sense, what conditions you would accept. The clearer you are in advance, the more likely you are to act rationally when fear dominates. Knowledge compounds faster than money. At the same time, none of this works in isolation from policy. Local housing restrictions matter. NIMBYism matters. Not in my backyard, policies are among the most powerful forces driving scarcity. If you want long-term relief, pressure for more building, more density, faster permits. In a healthy system, inflation should be near zero. People should be able to save without watching their purchasing power evaporate. That should not be controversial. Yet, here we are. Still, waiting for reform is not a plan. The system changes only after pain becomes unavoidable. So your primary focus must be controlling what you can. You do not control Washington. You do not control the Federal Reserve. You do not control boomers, Wall Street, or zoning boards. But you control you. You control whether you sit in cash while inflation erodes it. You control whether you learn how assets work. You control whether you stay passive or become intentional. You do not need perfect timing. You need clarity. You need to understand that money behaves more like physics than morality. Incentives drive outcomes. Once you see the structure, the moves become clearer. No one becomes financially secure by accident, but many have done so by understanding how the game is rigged and still choosing to play it intelligently. The system may not be fair, but it is legible. And once you understand it, you stop waiting for permission. There is a temptation, once you see the full picture, to feel defeated, to conclude that the game is rigged beyond repair and that effort no longer matters. That reaction is understandable. But it is also exactly what the system quietly relies on, because resignation is cheaper than reform. The truth is, every economic system rewards understanding, even deeply flawed ones, especially deeply flawed ones. And history is full of periods that looked hopeless to those living through them, only to appear obvious in hindsight. The 1920s felt like permanent prosperity until they did not. The 1970s felt like stagnation without escape until productivity returned. 2008 felt like the end of faith in markets, until capital regrouped and concentrated even further. Each crisis reshuffled power. Each one punished those who waited for normal to return. This moment is no different. The uncomfortable reality is that asset ownership remains the dividing line, not because it is morally superior, but because inflation makes it unavoidable. Currency is no longer a stable store of value. It is a medium of exchange that slowly decays. And in such an environment, holding assets is not greed. It is defense. This is why understanding the rules matters more than protesting them. If you own assets, inflation works for you. If you do not, it works against you. That is not ideology. That is arithmetic. And yet, asset ownership does not have to mean excess. It does not require speculation or recklessness. It requires intentionality, a shift in mindset from consumption to allocation, from short-term comfort to long-term resilience. That shift is what separates those who survive inflationary periods from those who are quietly erased by them. The housing market, for all its distortions, still reflects this truth. Ownership, even imperfect ownership, historically changes outcomes. Not immediately, not painlessly, but persistently. This does not mean buying recklessly. It does not mean stretching beyond sustainability. It means refusing to sit idle while the system extracts value from inaction. It also means understanding that progress is rarely linear. There will be drawdowns, periods where buying feels foolish, moments where the narrative turns dark. That is normal. In fact, that discomfort is often the price of admission. The greatest mistake people make during periods like this is assuming clarity will arrive first. It never does. Clarity follows action. Those who bought during prior affordability crises did not feel confident. They felt scared. They felt behind. They felt like they were making a mistake. But over decades, time rewarded their willingness to step inside the system rather than waiting outside it. That does not mean everyone should buy now. It means everyone should understand why waiting carries its own risk, because inflation does not pause for hesitation. This is also why the middle class matters so deeply. A society where ownership is broadly distributed is more stable, more cohesive, and more resilient. When ownership collapses into a narrow elite, social trust erodes, political polarization intensifies. And eventually, reform arrives the hard way. History is unforgiving on this point. Empires rarely fall because they run out of resources. They fall because the incentives that once aligned effort with reward break down. When citizens no longer believe participation leads to progress, legitimacy dissolves. Housing is not just shelter. It is psychological infrastructure. It ties people to place, to community, to future orientation. When that anchor disappears, something fundamental fractures. That is why this crisis feels existential, not just financial. But even here, agency remains. You can choose to understand how money works instead of moralizing it. You can choose to learn how assets behave across cycles. You can choose to position yourself patiently and deliberately rather than drifting. You do not need to win big. You need to stay in the game. That might mean starting smaller than you hoped, living less comfortably than you imagined, being flexible where pride tells you to be rigid. It might mean delaying gratification in ways that feel unfair. But history suggests something important. Those who adapt during transitions often emerge stronger than those who cling to vanished norms. The American dream did not disappear. It mutated. And like all mutations, it favors those who recognize the change early. You do not need permission to act. You do not need perfect information. You need a framework, an understanding of incentives, and the humility to accept that systems do not care how hard you work, only how well you position yourself within them. This is not cynicism. It is clarity. The system may be rigged, but it is not random. And those who learn the rules, even late, still have a chance to play. The future will not belong to those who waited for fairness. It will belong to those who learned how to navigate imbalance without losing their values. That is the real lesson of the housing crisis, not despair, but discernment. And with that, the question is no longer what should have happened. The question is what you will do next. If this helped you see the housing crisis differently, stay with the channel. More stories like this are coming.